relocating to California, and he ended up wanting to come home because it didn't work out. And there was an opportunity on his block where, he was going to end up paying over $100,000 more than what he sold his house for. But he didn't care because it was sentimental. He wanted to live on that block. Now, fast forward 10 years now from when that happened, would you say that he realized that $100,000 that he overpaid for that house? Of course. So time kind of heals all, in my opinion. So again, you can't time this market, but I believe it's time in the market that matters.
We're going to wait till the market slows down. You can't wait for the market to slow down.
No,
because no matter what, I mean, historically, when has the market ever been? When has the market ever gone down? In 2008, when we had that major crash, and then maybe one other time.
Right.
Other than that, historically, the market has always risen. Yeah, we're going to have some dips here and there.
But in the long run, you're gonna make out in the end, and that's the most important thing. I have a client that last year we kept on making offers, getting outbid, and there was one in particular that stands out to me where it was probably about $75,000 more than where he wanted to be, and he declined to move up. But now, when you think about what he was paying, he was probably paying in rent close to about $40,000 a year. Now you factor in a year's worth of equity lost on that house, and now where the rates are today, that person who passed up on that house, he should have pulled the trigger at the $75,000. I know it seemed like a lot for him to absorb at the time, but now looking back, hindsight's always 20/20, right? So, but it's similar stories. I think we have a ton of them in your end and my end that you can't wait.
Yeah, even like the house that I live in now. I mean, the equity that we've gained over the past 10 years is incredible. Yeah. Number one. And number two, I mean, like the interest rate that we're paying is I mean, it's I don't want to mention what our interest rate is. People will get jealous now. But even still, today's interest rates are, I mean, they're not horrible.
No.
People are like, oh, it went up to 5%. It's like, listen, we've been at 3.5%, 3% for how long?
It's been a long run.
Yeah, it's been a long run. So it's good. I mean, something has to change in order to stabilize the market a little bit.
Right, which they're trying to do by raising the Fed rate. They're trying to curb inflation, obviously, but that can go either way, right? So it's a fine balance whether or not it pushes us into a recession. And now talk about history. History tells us if a recession happens, what takes place? Interest rates go down. So look, you can't again. You can't. It's all speculation. You can't forecast what the market is going to do. Clearly.
Yeah. My brother used to have a good analogy. Your house is like a stock, and it's only worth what it's worth on the day that you're ready to trade it. The market value is going to adjust, and your house value is going to adjust a little bit. I think going into the rest of this year and then the beginning of 2023, we're still going to have a very strong market because supply is down and demand is still there.
Yes, I agree. Yeah. So, I mean, a couple of things that we're looking at to kind of combat some of the unstable market. We're looking at doing adjustable rate mortgages. I know that's like a dirty word, right, in the industry, adjustable rate, but they're not a bad alternative. If you're looking at a first-time home buyer, history tells us that the average stay in for a first-time home buyer is between 5 and 7 years. So you could look at a 5-year ARM, a 7-year ARM, which basically means that the rate would be fixed for that set period of time, either 5 years, 7 years, or 10 years. And as a benefit, you usually get a little bit lower of an interest rate. So that can help offset some of the the influx of payments because of where the 30-year fixes are today. That's something that we're starting to see more of. And then also we're looking at extended rate lock opportunities, right? So, being that everything is still volatile, if you're, on the side of the fence that thinks that the rates are going to continue to rise, one of the ways that we can offset that is by looking at extended rate locks, and we can look to secure a rate up to 360 days. A little bit more involved and something that we can talk through, but it's definitely an opportunity for potential home buyers to protect themselves against rising rates.
in mortgages, like, you know, people are qualified and then all of a sudden they're not qualified, or
in some cases, yeah. I mean, if you were pre-approved and you were pushing the envelope in terms of your max budget to get a house, yeah, there's no doubt with interest rates a lot higher than they were, that can definitely push you out of being able to secure a mortgage. So yeah, if you've been approved a few months back, it's definitely important to reach out to a loan officer, or the one that you did secure pre-approval for, and make sure that that your numbers are still valid with today's rates.
Let's talk about what's going on in the market. I mean, let's just talk about like Smithtown. We're both from Smithtown.
Yep.
Smithtown people. So right now, 58 homes available. So I feel like inventory has risen. Last month there was only 36 homes.
That's good news.
Historically, you know, I looked at a market video that I did back in 2018 when there was no COVID or anything like that. And historically, there's typically about 100 to 120 homes on the market in Smithtown at any given time back then. So we're still at we're still at a little bit more than half of our regular, what people consider inventory. So that's what's creating the demand.
Yeah.
You know, but interestingly enough, you know, I pulled up some stats this morning. You know, there's been 6 price changes in Smithtown. There's 5 extended listings, meaning they didn't sell and they're, you know, having to be extended for one reason or another. And then there's 2 homes that are back on market. Average list price in Smithtown right now, average across the board, is like $706.
Wow.
And the average sold price is $665.
It's crazy. The numbers are crazy. The house that I live in currently, I think we bought for about $580, and that was back in 2008. And, you know, I mean, obviously the values are subjective today, but, you know, could I get 800,000 today for my house? Probably. Am I selling today? No. Will I end up getting 800,000 when I do sell it? Probably not, you know, but it's still going to be more than what I paid for. And that's really the truth of real estate, is that it's the time in the market that is the most important. We can keep going back to that common theme.
Yeah. Yeah. I mean, if, you know, if you're buying to stay here for a little while. You're not buying to turn over, unless you get a job relocation or something, you know, happens in your family where you have to move. You're buying to stay. So typically people stay in their homes from, you know, 10 to 15 to 20 years, sometimes longer.
Yeah.
You know? So I think people feel like there's no inventory just because the market's moving so fast. You know what I mean? Average days on market in Smithtown is 17 right now. It's like, put a listing on, take it off, put another listing on, take it off, put another listing on, take it off. That's how fast the market is. And I think that's all across, you know, Long Island, well, across the nation for the past 2 years.
Yeah, I agree. And I mean, listen, and obviously everybody has certain expectations. They have wish lists in terms of what they're looking for in terms of buying a home. You know, maybe sometimes it's better to be a little bit more flexible. There are other loan programs like renovation loans that are available to you, where you're able to leverage the bank's money in your favor to make a house the way you want it. Maybe it's a matter of maybe putting a little bit less money down, holding on to some of your cash to make some home improvements and make it the way you want it. So maybe not be so close-minded to the way a house looks, but really focus in on the area that the house is, where it's at. And try to make a decision based on you know, location, not so much you know, what it looks like.
You have to look at the bones of the property and be like, all right, I can work with this.
Right. Well, listen, I mean, everybody wants that, you know, that turnkey home, and it's just going to be that much more difficult for you to get an accepted offer, right?
Yep.
And you're going to compete against a ton of buyers. You know that the price is only going to go one way, which is up. So, you know, again, maybe finding that diamond in the rough, you know, giving yourself a little bit more opportunity to, you know, to make it the way you want it. Yeah.
What are some of the things that you've been helping buyers with to help them leverage their offers?
Pre-commitments. That's great. That's a great point. Pre-commitments, pre-approvals. we used to do for everybody. We still do them on occasion, but for the most part, we want to get your buyers pre-committed, and that's a formal underwritten approval. So we collect all your documentation, pay stubs, W-2s, bank statements. We have you fill out an application. We submit it to an underwriter. We're essentially mirroring the process as if you identified a house, did your inspection, went into contract, and applied for the loan. We're doing the same thing, except we just put a TBD as a placeholder for the address. So now it takes any risk, away from the seller, in terms of a potential buyer coming in, not knowing whether or not they're really valid. Well, that definitely puts them in a more favorable light. And I will say this: if a buyer is not doing a pre-commitment today, they're putting themselves at a disadvantage, because there are other banks that are offering this service. And if they're going in with a pre-commitment, which is almost like a cash offer.
I was just going to say, it's like, people are getting beat out by cash offers, but if you have that pre-commitment, now you could leverage time, give the seller time to, you could be flexible
with your closing time.
With your closing time, but you're already committed. So you're essentially saying, hey, look, I have a bank backing me and I'm flexible.
Yes. Yeah. And it gives them the peace of mind to know that you have been 100% vetted. I mean, if you go back many years ago when we were doing pre-qualifications, what happened? People were making offers, you get into contract, and then you'd find out later on that they couldn't qualify. Right. So then that deal would blow up. So then they moved to pre-approvals, and pre-approvals were supposed to be fully vetted. Unfortunately, that wasn't really the case. My experience was that they just kind of deleted out the word pre-qualification, inserted pre-approval in there, and everybody was happy. But, look, the reality on a Sunday afternoon, if you have a client that needs a pre-approval, well, how am I necessarily going to vet that all the time? You just can't. So you're trying to, especially in this market where everything is hot, you have to be able to be responsive, right? So but having that pre-commitment, doing that up front is really paramount. It definitely will set the right expectations. Look, if you're shopping for a car, you're not going to go to Mercedes when you can only afford a Prius, right? So why would you do that in real estate? It really makes no sense. Why people go to you folks first, opposed to the bank, to find out exactly what it is that they can afford is obviously something I never really quite understood, but it's just the way our market is and the way it's built.
I don't know. I mean, people, they're under this notion where they want to see what's out there and all that. And it's like, all right, listen, either you're committed or you're not committed, like, do you want to buy or do you just want to shop?
Right. Window shopping. Yeah.
Yeah. Yeah. Let me ask you one more question.
Yeah.
How are you handling appraisals?
In terms of when they come in low?
Is that a touchy subject?
No, listen.
No. How are you handling appraisals now that the market is starting to slow down a little bit? And, are we looking at all the COs? Are we looking at, what are we looking at? We could do a whole show on appraisal.
Yeah, we could. And that would be good. I think we should probably maybe do a segment on that. Yeah. As far as appraisals go currently, it's hit or miss. Some are coming in, some aren't.
Okay.
And in the event that they don't, we look at a couple of different ways to resolve it. Number one, we can try to dispute it. We work with the realtor to maybe look at the appraisal, see if there's any other comps that could have been used that weren't. Doesn't always work, but it's always it's the first attempt, and then from there, if there's no additional value that can be derived, then we go to renegotiation as a possibility, whether or not the seller is willing to concede a little bit on value. And if not, the third option would be to potentially look at manipulating financing, so that we can make the deal work that way. And that's something that we do from time to time, actually more so than I would have thought. So for example, if somebody was putting down 10% down, and then let's say the house underappraised by $30,000-$40,000, maybe instead of putting 10, you put 5%. So that 5% now you can use to bridge the gap of the appraisal. So that's something that that we're doing a lot of.
Okay. So you're just changing a couple of numbers here and there.
Yeah, and to be honest with you, when you look at the actual numbers, when you see the difference in payment, you'd be quite surprised that there really isn't that much of a difference.
right.
monetarily. So it's just really a number on a piece of paper and whether or not you can swallow it. Yeah, it's good stuff. So yeah, the appraisals aren't really that big of a deal, but at least in my opinion, it's not. But it's put yourself in a buyer's position, and if you're buying a house for say 500,000 and it appraises for 450, how would you feel about it?
Right, and I could see that point there. I think there are some buyers that get stuck on
The number.
C of O's and stuff like that.
Oh, COs aren't really that big of a deal any longer.
Yeah.
It depends on what it's for. I think, but mostly we can work through it.
Right.
Yeah, banks have become a lot more lenient when it comes to COs, and outside of New York, these things don't even exist.
No, I know.